Long before you click the buy button, global currency pricing is already surging through data centers at the speed of light. For years, retail trading forums have passed around the same campfire story. Market makers are out to hunt your stop losses, while pure ECNs give you a pristine, conflict-free line to the interbank market. But that binary choice is a relic of the past. Today, you are trading in a hybrid reality. Brokers use sophisticated algorithms to profile your account and route your orders dynamically, depending entirely on your trading volume and strategy toxicity. That means you might open an account advertising 0-pip spreads, only to watch a perfectly good trade bleed out from a $7 round-turn commission. Or you might pay a premium for a direct institutional connection, but suffer massive price slippage right when the market gets volatile. We need to look past the marketing labels and audit the true mathematical costs of straight-through processing, ECN, and market maker models. The goal isn't to find an objectively perfect broker. It's to figure out exactly how you trade and match your specific strategy to the correct back-end plumbing. This flowchart illustrates how a dealing desk, or B-book model, actually works. When you enter a position, the broker takes the other side of your trade, acting as the market itself and paying out of their own pocket if you win. Now, watch the external path. In a no-dealing desk or A-book setup, your trade bypasses the local server completely and is routed straight through to external institutional liquidity providers. Your profitability depends heavily on knowing which of these books you are on and adjusting your risk management to match the environment. Every time you place a trade, you have to choose between predictable pricing and execution transparency. On a dealing desk, internal order matching protects you from chaotic market gaps and locks in fixed spreads regardless of the new cycle. But to get that stability, you accept a wider baseline spread and trade against a broker that benefits when your position hits a stop loss. On an ECN, you bypass the middleman. You see the true depth of market and get raw, 0-pip interbank pricing. The catch is the access fee. You pay a flat commission per lot, and you carry full exposure to real-world market slippage. This ledger calculates total costs. One lot on a market maker's fixed spread is $12. Under ideal conditions, an ECN spread plus commission is $8. But during news, the ECN spread widens, pushing costs to $15, making the market maker cheaper. If you trade microlots at 0.01 volume, the math breaks down completely. The flat ECN commissions cost the broker more than the spread they earn, destroying the profit margins of small accounts. A 0-pip spread is a trap unless you map out your exact transaction overhead against the volume and volatility you typically trade. And even if you are willing to accept the ECN costs, the reality is that the interbank market doesn't have to accept your trade. In STP and ECN environments, liquidity providers operate with last-look rights. This means Tier 1 banks get a few milliseconds to review your incoming order and reject it if the price has moved against them while the data was in transit. This chart maps how rejection creates negative slippage. You click buy but get filled at a worse price in the low predictability zone. Conversely, if a sudden price drop works in your favor, you land in the positive slippage zone and secure a better entry. Reputable ECNs will pass that positive slippage directly to your account. Dishonest market makers will pocket the difference and fill you at your original, worse request. Brokers constantly monitor this execution data to filter out what they call toxic flow. If you use high-frequency bots or latency arbitrage to exploit pricing lag before the broker can hedge, you trigger their internal alarms. To protect themselves, the broker will deliberately shift your account to a high-latency environment, burying your strategy under frequent requotes and heavy slippage. Managing your reputation with your broker's algorithm is a core component of your strategy. If they flag your flow, no amount of capital management will save your drawdowns. Stop looking for a flawless broker. Match your execution style to the environment built to handle it. This strategy broker fit matrix shows exactly where you belong. If you are a high-frequency trader or scalper, your flow routes directly to an ECN or A-book. You need fractional pip advantages and absolute minimum latency to survive, making the flat commissions an acceptable cost. But if you are a swing trader, the matrix shifts you straight into a market maker or STP hybrid. When you're targeting 200 pips over several days, A 1 pip spread difference is irrelevant. You need to avoid overnight commissions and secure guaranteed fills on your stop losses. And if you trade heavy news events, pure ECNs are crossed out entirely. You need a hybrid model that offers slippage protection when liquidity dries up. If your trades suddenly take 500 milliseconds to execute, or you keep hitting phantom price spikes that only exist on your platform, you are trading on the wrong book. Audit the mechanical realities of your execution. Stop paying for market transparency you don't use, or accepting severe slippage on setups that require absolute precision. Download the FXNX Broker Execution Audit Checklist. Run your last 50 trades through it and ensure the plumbing